everybody, what's going on? It's Thursday, January 12th. Good day today, but I'll say this, the market has to be higher than where we are right now. We have completely recovered the December 15th tax drain and then some. We're actually like 24.4 billion above where we were right before that tax drain. So we recovered the whole entire tax drain and added an additional 24.4 billion. So at the very minimum, I've been saying that the S&P should be, 4,000 to 4,100, and that's being really conservative. I mean, it really should be higher than 4,100, and it's like struggling just to hit 4,000. I still think we're definitely going to see higher levels. But it's just you can see in the hesitation that there's still a lot of bearish sentiment. Looking at the AAII weekly sentiment survey, I mean, bulls were still low. Bears have come down for the last 3 weeks. So we have like a 3-week decline in bearish sentiment. It looks like they moved into the neutral camp. And bearish sentiment is now the lowest in 3 months, but it's still elevated. It's still about 30% above the historical average. So, we still have this environment of a low level of bulls, high level of bears, although bearish sentiment is starting to come down a little bit. That's a good sign. And like I said, we're going to see, we've been 60 weeks now. If you look at the bull-bear spread in that AAII sentiment survey, that's been negative for 58 out of 60 weeks. So, I mean, when that thing turns, it's going to stay positive for a long time. And, you're going to unwind all of that bearish sentiment. I mean, that still has yet to come. And don't forget, there's this massive belief out there that this year is going to be a recession, and it's not even really up for debate. I mean, if you listen to the commentary, they're like, it's 100% probability. Well, what does that mean? That people literally saying it's a certainty. It's a certainty. Yesterday we had a very, very strong, I think it was like a record 3-year auction. Today we had a record very strong 30-year auction. Folks, a couple of things I want to say here. Like people are chalking this up to some reduced inflation expectations. We saw today's CPI was 0.3%. And the narrative on all this, if you read what's out there, it's people saying, that means the Fed is going to slow its pace of rate increases. Well, we knew that. I mean, that is baked into the market. It's not like some new revelation. You see how incredible this whole thing is, folks? I mean, are you really paying attention to this stuff? Because it's very important to pay attention to these narratives, like the way people rationalize things, because they just contradict themselves left and right. I mean, the slowdown in the rate increases, that has been baked into, if you look at Fed Fund futures, it shows 25 basis points coming up in February. Everything that they're saying now is like, an adjustment in rate hike expectations or the trajectory. It's all the same. Nothing has changed. So that expectation has been built into the market for quite some time now. So they're just looking around at how can we rationalize what's going on right now? How can we rationalize the bond market going up and rates coming down and the stock market? You see that they got to try to find a way to explain, and they're getting a little hot under the collar because this was not supposed to happen. You still have this guy, Mike Wilson of Morgan Stanley, this perma bear. He said the market's going down another 22%. And of course, all of this is based on monetary policy. So if the Fed is not saying this, by the way, that's another thing. The Fed, and I said this yesterday, that the Fed keeps, they keep pushing forward with their macho, we're going to keep on raising rates to crush inflation. We don't care what the numbers are, this macho talk, and then the market keeps going up. Inflation keeps moderating. The bond market is rallying. So the bond market is not even paying attention to the Fed's macho talk. And here's the thing, folks. This is where MMT, if you have an understanding of MMT, and I'm going to tie in a few things here, so follow me on this. In an environment of increasing fiscal, where you're literally filling up the swimming pool, right? Where the balances in the system, the financial balances of the non-government, us, that's being added to, the supply of money being added to, that puts downward pressure on interest rate. This is what's causing the rate drop, okay? It's not, I'll admit maybe there is some of this expectation of falling inflation that also is kind of woven in, and it's an element, it's a factor in the rate drop. But it's like, to use a swimming pool analogy again, but kind of like, let's just use in this case like a water analogy. The more water you have, if there's a shortage of water, right? If that water is being drained out, then water is precious. It's costly. But if there's a flood, look what's going on in California. You couldn't give that water away. There's too much of it. Okay, so the same thing now in a fiscal expansion, right? Where you're creating more of that supply of financial balances, all right, and now don't just think about reserves in the system, also think about government securities, right? The total balance, when that's expanding, net spending of government, when that's expanding, then you're going to have downward pressure on the interest rate. It's like, again, in California, you couldn't give that water away right now. There's just too much of it. And, on the flip side of that, you look at some desert, the Sahara Desert, water is a precious thing. It's costly. You got to pay for it. It's not a lot of it. Same thing here. Same concept here. This is what's causing the downward pressure on interest rates. That's point number one. Point number two, which I have, I've spoken to you about this. Look at what's happening to the dollar. The dollar's weakness now, and today we had another big drop in the dollar, big rise in the yen. The dollar's weakness now reflects the expansion of fiscal policy, creating more dollars. The dollar's decline reflects the expansion of, if the dollar wasn't going down, if the dollar was going up, then my thesis would be suspect. Any one of you could come back to me and say, well, Mike, if that was true, look at the dollar, it's getting squeezed higher. It's not. It's not, and that reflects the expansion of fiscal policy, and it's going to continue. Now, I said that you got to be a little bit careful shorting the dollar, which I've been doing and making really nice money on it, but I wait for the rallies, the blips up. Today, for example, I didn't do anything. The dollar was down, and I don't sell into weakness. I sell into strength, or I buy into weakness if I think the thing is in an uptrend, okay? So, and that's going to be true for most of this year. Now, again, I'm going to remind you of what I've been saying since, last Friday when Kevin McCarthy got elected Speaker of the House. We got to be careful, not now, but we got to be careful in the fourth quarter, around the end of the fiscal year, September 30th. What is the budget situation? What is the debt ceiling situation? What is the fiscal picture going to look like? I said yesterday that there's been a lot of rhetoric now, more than I could remember in a long time, about the debt and having to do something about that. And silly, ignorant, comments about, hey, the government's got to balance its books. Like, enough is enough. This is, we got to understand that this is out there. And this is going to come back into the picture, and it's going to be a real issue. Now, I'm not saying that it's a doomsday thing. We got to see how this is going to play out. I mean, right now, we got nothing to worry about, basically. And I've been telling you that we're going to get a rise in the market into mid-February. Because mid-February, February 15th, we're going to get a quarterly interest payment. That's going to be the peak of the fiscal flows for now. Then we get into a bad period, which is going to be March and April. Those are big tax drains. March is another quarterly corporate tax drain. April, of course, April 15th. That's going to take us, negative into May. And then we'll start building back. And then we're going to have, May, June, July, August, whatever, summer. It's still a ways off. But I'm giving you the blueprint of how this is going to play out. The other thing I should mention, because I mentioned the dollar indicative of the expansion in fiscal, so is gold. Look at what's happening in gold. And if you wonder why last year gold was down, even though inflation was so high, we had like almost a 2 trillion reduction in financial balances because they cut spending and taxes were very high. I've been over this like so many times. That was a record drain in how much they took away in terms of fiscal support. So gold went down. Not hard to understand. Gold's going up now because we're replenishing that supply. All right? So that's another indicator. If you want to have another indicator which corroborates what I'm saying as far as the fiscal expansion, that's another one right now. You got stocks moving back up. It's all the swimming pool, folks. I mean, this swimming pool analogy that I've given you, I don't see any other way to make it any more simple to understand. I mean, I think a lot of you really get it now. And when you have this understanding, and you can see it very simply, without all the mumbo jumbo of Wall Street and Fed policy and, what are they going to do with QT and I mean, all these people, they're like, looking at this tiny little thing through a microscope, and here we are with the big picture where basically you could go out, you could play golf every day, you could go fishing, whatever. You're going to beat these guys. You're going to beat these guys. They're all wrapped up in their minutia, which, by the way, they don't even really understand what the hell it is they're talking about. Okay, they get that wrong. It's bad enough that they're so, buried into their little minutia crap, but they don't even know what the hell they're talking about. So, I mean, it's like, it's just crazy. And they're so freaking, micro focused on this stuff. And we're just out here saying, all right, man, we see the big picture. These things take time. When the flows are going, it's like, think of the beach and the tide coming in, and you got a bunch of people like just staring at a couple of grains of sand, thinking and watching the waves come up, and it kind of looks like, I don't know, did the wave pass that grain of sand, or was it right on that grain of sand, or did it fall back? And they're just sitting there, wondering. And then we know that every 6 hours, the tide comes in, and then 6 hours later the tide goes out. So we're on the beach having fun, playing volleyball, whatever, relaxing in the sun, and they're all huddled around one little grain of sand trying to measure, did the water go past it? I'm not sure. It went past it this time, but it didn't go past it the last time. They don't see the freaking big picture. you gotta, the expression, keep it simple, stupid, KISS, right? You gotta keep it simple. And this is what we're doing over here. This is what we're doing over here. I mean, people say, well, I don't, when people tell me, Mike, I don't have time to follow this stuff anymore, so whatever, let's say I don't need your service, or I'm going to cancel, or whatever. I'm like, it doesn't take a lot of time. I mean, the value I provide is exactly what I just described on that beach. Like, I allow you to go play golf or go fishing or have your other projects. It's not like, my report is not, I got to study this, like really study this because, this one data point just changed and maybe that means that. No, it's like, here's the big picture. Go do what you got to do, but you want to have that big picture. That's a key thing. It's like I said many times, how many times have I had conversations with these asset managers who tell me, your stuff is really great, but we are bottom-up analysts, meaning like they crunch numbers. They look at balance sheets, they look at cash flow, debt of companies, individual companies, their financials. I'm saying, well, that's great. That's great. I wish I had that skill. Like, I might have it. I'm not a financial analyst, okay? I'm an economist. I wish I had that skill. Like, if I was an accountant or something like that. I mean, that's a really good skill, but I don't have that. But by the same token, like I've said, you could be the best financial analyst in the world. You could spot those, those companies that have beautiful financials that maybe people, they don't see it, or there are things in the numbers where you see something that nobody else sees, and that's fantastic, and you say, is it? But if basic economic conditions are not conducive to like a growth environment, then those numbers are really not going to do much for you until we get into basic conditions that are conducive to growth, and vice versa. It could be the crappiest company in the world. I mean, how many times have we seen it? But if you're in a growth boom, a lot of things get lifted up. You don't have to be a genius. What I'm trying to do here is to make it simple for you, to make it easier so you can have a life. Nobody's asking you here. I'm certainly not asking you here to, sit down, and study this for 8 hours a day and crunch numbers. You don't have to. I hope that I've shown you it's not necessary. So that's it. That's it for today. And I don't know what else to tell you. That's it for today, and I'll see you tomorrow. Bye.